Yeah. So thanks everyone for joining. My name is Denis Kalyshkin. I'm the co-founder of Space Ambition, and I'm a US VC. I've been in the VC world for 12 years now, and I invested a lot in boring legacy and sexy industries, but I also invested in deep tech, and I have an aerospace engineering background. So this is why me and my colleagues we've launched Space Ambition a few years ago. And we started from sharing the insights about where the sector is moving, what deals are made, how to make investment decisions. And our idea was to inspire people to go to pursue the opportunities in the niche, as well as better understanding what's happening and how we put something into practice. And one of the equations, of course, is venture capitalists, the people who provide capital to do the deals. And because of this is why I'm doing this webinar today. A few years ago, I've published an article and I've looked into the case of investments of Rocket Lab. And today I will walk you through through my findings, and you can read it afterwards or watch this video later. And if you are, for whatever reason, you are planning to invest in space tech or in deep tech in general, because there are very many overlaps between investment in space tech and deep tech, because a lot of problems are, founders experience a lot of problems which are more or less the same. So if for whatever reason, if you're a family office, a corporate, a venture capital, a business angel group, or for whatever reason, you're interested in the topics and want to better understand how to make these decisions, how to look in the companies, please don't hesitate to reach out to me. I will send you my email because we are doing consult advisory for such people. Or if on the other hand you are a startup founder doing a deep tech and thinking of expanding your business, thinking of raising funding, please also reach out to me, and yeah, I'd be happy to help. So today we will be looking into the case of Rocket Lab. It's a public case which was published by Bessemer Venture Partners. So what I did, I initially took the investment memorandum, and then I applied my framework for analyzing startups. And I either used the information from the investment memo of Bessemer, or I processed this information and added some understanding, my understanding of the deal based on the information which was available as of date of October 2014. So we won't be using any information from the future for this exercise, and we will be discussing the Series B round of Rocket Lab. This typically takes us about an hour to walk through this case. Yeah, you will have. So if you have any questions, please write them in the Q&A session in the comments, and I will be regularly looking at your comments and probably answering them. Yeah. So this is how we will be working during the next hour. Yeah. So let us start. So first of all, every time we consider a deal and every time we write an investment memorandum, we always do such a quick overview about the deal, which is happening. And now before we delve into each aspect of the framework, I will focus the attention, do a brief summary about what the deal which was considered. So first of all, Rocket Lab is a rocket company. Now it's more sophisticated business, but in 2014 it was a company which was developing rockets which were going to launch small payloads up to 150 kilograms. And as of October 2018, Bessemer was considering a Series B round for $20 million. And along with them, there were investors, strategic investors, K1W1, it was they invested in their previous round, and Lockheed Martin and Incotel, this is a telecom company, which were also planning to join the round. Why I stress specifically on this? Because it sends a positive signal. So first of all, the investor of the previous round, K1W1, is doing a follow-on investment. It means that they are happy about what's happening with of the company. So this is kind of a positive signal always. Then we have two other investors, strategic investors like Lockheed Martin, for example. And we will see below that Lockheed Martin was also a partner with DARPA projects. So they deeply understand, they understand deeper the field, and they completed the projects together with Rocket Lab. So this was also a positive signal that they are considering investments in the current round. And this gives more comfort to the lead investor. The other thing which I want to stress, as it always is the case with deep tech companies, it's always great to have an non-dilutive funding. And in case of Rocket Lab, it is a New Zealand company, and the government of New Zealand was going to invest to cover up to 20% of the costs, which could be of the costs incurred by the company up to the limit of 25 million. So it was providing $4 million in additional non-dilutive funding. This is also one additional, good point about making this deal. Then, as of the date, the other thing we need to pay attention is like where the company was in terms of the traction. So as of the date of the deal, Rocket Lab was still still didn't launch any satellites, so they didn't do their test flights to space, but they were planning to do the first test launch in late 2020 into 2015, and it means that it will happen like 9 months, so up to 12 months after the investment. And they were also planning to invest. They were also planning to do 3-4 launches, 3 more launches, and one commercial launch by mid of 2016. So it means that during this investment round, Bessemer was expecting to get the first commercial traction. Then the other important traction part of the other important thing about the traction is that the company has a current pipeline of 40 launches, and it is a pipeline for $200 million. So it means that, and we will look in it below, that they have like pretty good chances for the commercialization. And the other aspect is that Peter Beck, the founder of Rocket Lab, believed that Series B will be the last investment round because he expected that the company will get to break even. But Bessemer believed that it was an aggressive plan, and later we will look into why they believe in so. But in general, first of all, as it always happens with deep tech companies, you always get some delays when you build your technology, send it to space, etc. So they were a little bit less aggressive in the go-to-market, but on the bright side, they believed that even if the company will experience some delays, and if they need additional funding, so far the company is not that has not raised that much funding, and they have a pretty healthy cap table, because the only investments which previously raised company was 5.5 million from Khosla Ventures in their Series A. And the majority of the company still holds the team. So if they need another round of investment, they can get this another round. So this is why they were not that concerned about this point. So Before we delve into the deal, I want to set the scene because it was like 12 years ago, so probably not all of you are familiar how the space tech sector looked like back then. So imagine we are now in October 2014, and the new space era began only in 2010. So it means that like we're just this the sector is just gaining the momentum. And if we look at SpaceX, so SpaceX was launched in 2002, but it was nearly bankrupt in 2008, in September 2008, and only after the fourth success or after the fourth launch of their rocket, they just for the first time they experienced like the successful tests. And yeah, I'm looking at the comments. Was it a positive for Bessemer that they expected more funding need than expected by founder, i.e., a risk of dilution versus of the deploy of capital into Rocket Lab? So in general, of course, it's better when the founders and the VCs are more aligned about the future funding. But back then, I believe so it would be better if they were more aligned with the founder. But I believe that they liked the founder. They liked the founder, and they believed that if it comes to the case where they need more funding, the founder will listen to them, and everything will be fine. But of course, it's better when the founder and the investors are on the same page when they talk about the future of the company and the future funding perspectives, etc. But is it always the case? We don't know. Like, okay, we're not doing the round. In 2 years, we will go to markets and grasp another round. How big the round will be, where the company will reach. It's pretty uncertain, especially when it comes to the deep tech companies. So we need to take some risks. So I would say that it was not that mission critical. So getting back to the deal. Rocket Lab was so back then. SpaceX, as I said, like only in 2000, in September 2008, the company was almost bankrupt. And then, after a successful launch, they pulled over. They were awarded a 1.6 billion contract with NASA in December 2008, and then they raised a billion in government funding and 250 million in private funding, and they reached the 9.8 billion valuation. So SpaceX was a company which was gaining the traction, and they had rockets which were flying back then, but they were not like they were not the SpaceX we know now. So when investors looked into the scene back then, they saw that like rising stars, no clear winners, and an opportunity to back some other players. Then, if we look at the Blue Origin, they started in the early 2000s, and did their first flight in 2006. But then, for several years, there were no news about them until 2013, when they announced plans to do an orbital launch in September 2015. So looking at this scene, and if you look at the Virgin Galactic, so they were founded in 2004. And they raised $100 million from Virgin Group, and then additional 390 million from mini investors in 2010 and 11. But in 2014, they were negotiating with Google about the potential investors, but investments. But Virgin, first of all, were going after the space tourism business, not the launch business for not building the launch business for small payloads. So all in all, it was more like signals of first positive companies raising funding and getting their first traction, rather than like oversaturated markets as it is now, for example, with launch companies, where more than 120 companies are building space launching startups. So back then it was a different story. So when investors looked at Rocket Lab back then, they saw more opportunity. The other risks were like potential underfunding because there were very few VCs which could invest potentially in space tech. But from the perspective of how saturated is the market, it was like emerging market. Yeah, and if we look at the Rocket Lab. So Rocket Lab was founded in 2007 in New Zealand. In 2009, they launched their Athea 1 project, and they became like the first company in Southern Hemisphere, as they brag, which reached space. Then, during the trip to the United States, at some point, Peter Beck realized that there was a niche for small payloads. And in a minute, I will tell you why this niche was that sexy. And he also met Mark Rocket, who became his first seed investor. It's the US investor. And he was a co-director between 2007 and 2011 for the company. And I believe he contributed a lot into like helping Rocket Lab to like Peter Beck a little bit around the business acumen and fundraising in the United States. So, and yeah, and in December 2010, Rocket Lab was awarded the US government contract with ORC to study low-cost space launches and to place CubeSats into orbit. They also demonstrated this in the DARPA project and in 2000 and released an UAV in 2011. They also had demonstrated a 3D printed rocket engine in 2013. So, and as October, they had 89 sounding rockets launched for the last several years. And this contract was done like with DARPA and Lockheed Martin. What I'm saying is before these Series B investments, they had both significant technology traction, and they've done a lot of tested a lot of the technologies on the ground and in small launches, but not in space. And they also partnered and did contracts for DARPA and did contracts together with Lockheed Martin, which was a good signal, like a positive signal for investors. Then, because of those signals, in 2013, they raised $5.5 million from Khosla Ventures. And by the way, later, Khosla Ventures has backed many space tech startups and became pretty famous about it. But I'm not pretty sure if back then Khosla was that bullish and like made so many deals in space tech. So I don't know if it was like in general a good signal that Khosla was investing as a space tech investor, but definitely Khosla is a good brand and shows having them on the cap table on the previous round was a positive signal for Bessemer. That's for sure. Now we will discuss the competitors below, but on one hand, what VC saw that private space was getting momentum, and on the other hand, already several companies got good funding, but all in all, it was more positive. We saw more positive than negative signals for Bessemer to invest in the niche, and it was given like showing pretty good perspectives. So now we will go through our framework, and the first thing we need to answer when we make a decision if the problem is real, if it's a painkiller or a vitamin, and it affects how. It affects on the sales cycle and the margin of the business and the pace of sales. Because if you have a painkiller, so painkiller is a product which you can't survive with, then it means that clients will be in immense need to buy your product. Versus if you have a vitamin, so it means that checks will be smaller, margins will be lower, sales cycles will be longer, and you can be sure that the startup will make it. So when it comes to Rocket Lab, they were addressing a niche of small payloads up to 150 kilograms. And back then, the only viable option was ride sharing. It means that larger payloads could take as ride sharers small payloads for their launch. But the problem with this approach was if the big payload was delayed, and it happened all the time, it could be delayed for months, then it means that your payload was also delayed. And those businesses, they were really dependent on the on the launches of the bigger rockets. And for example, we will see it in a minute, but Planet Labs faced it immensely, and Planet Labs was planning to launch a big constellation, and each delay was significantly affecting the commercialization of those satellites. Getting to the orbit faster was not a vitamin; it was a painkiller for many businesses. And to persuade themselves, Rocket Lab also Bessemer also talked to their portfolio company Skybox, which was also launching satellites, small satellites in space, and the Rocket Lab also confirmed, and this company also confirmed the need. Now, the second part of the framework is, of course, the product. So I wouldn't go into details of the product. So it was a 3D printed rocket with some specifics of the technology. I will more focus on the business side of this equation. So they were going to launch launch small payloads loads up to 150 kilograms to the orbit up to 500 kilometers on the sun-synchronous orbit. So it kind of the most widely used orbits. So this is why many of satellites are launched on this orbit, and especially for Earth, ideal for Earth observation. And they were planning to do launches every week. Then they were planning to launch that the launch cost would be about 5 million for 4.9 millions of dollars. So it is about $49,000 per kilogram of payload. Yes, it was more pricey than SpaceX back then, but they believed that that clients are open to pay extra just because they get more flexibility of the window of the launch, and opportunity cost was higher. And the other thing which is important to stress is that the cost of the rocket was $1 million. Why it's important, later we will be talking about the potential risk of potential newcomers in the space and increased competition. The cost of 1 million means that they had like a lot of opportunities to cost optimization, price optimization, and if the competition becomes fierce, they can drop the prices. The other thing which I want to focus on was their business innovation about how they prepare launch for the payload for the launch. So before a Rocket Lab, if you're a client, you send your payload to the launching company, and then on the launching side they prepare your payload for the launch. Instead, Rocket Lab introduced another approach. They said you package it and test it yourself on your testing ground, and then send the payload prepared for the launch to our launching site. And we at our launching site we have many ready payloads. And if, for example, you scheduled your launch and for whatever reason you decided like to postpone your launch, just for example, you as a client need to do some adjustments in your payload, they take it off the rocket and replace it immediately with another payload. So it was like pretty cool innovation. And finishing up our conversation about the product, another thing which you need to pay attention is that they were from New Zealand, and since they were like rock stars in New Zealand, they benefited from lower government launch cost fees. The government was charging only $400,000 per launch. Compare it with several $100,000 $700,000 in the United States. Of course, it wasn't like dramatically changing the situation, but it was additional extra cost savings which they could enjoy. Yeah, give me a second. I will look into the comments, the questions you're asking. Were the $200 million pipeline side contracts or simply letter of interest? Was the profile of those customers, VC-backed startups, government contracts? So, okay, I will answer to this question while we come to the traction section. Those contracts were materials. And another question, what was the time to fulfill the launch order? I don't know this information, so I'm not like I'm taking the public information from the investment memorandum. I can't answer the second question, but the first I will cover in a few minutes. So the next part of the framework is of course the business model, and their business model was simple. They charge per kilogram of the payload, and they were going after those small satellite owners and launch brokers. There were several brokers which were providing the ride-sharing opportunities. And as of the time of the deals, they had commitments for 40 launches, and including six launches which will be happening in the first year of 60 launches, which will like one of the brokers was going to commit in their first year of operations. So it's a strong signal. Now let's talk about the market sizing, because every time when we do investments in any company, including space tech and specifically for space tech companies, we need to assess the size of the market, the so-called total addressable market. And many startup founders in space tech, they failed with this because they are so passionate about launching something into space. But if you calculate the market and potential market, it's so small. And but in case of Rocket Lab, they had big total addressable market. So we will talk about it. But if you're a startup founder or if you're looking at the space tech company, make sure that the market is big enough. Or alternatively, for the majority of the cases, it means that space application is just the minor application, and you need to find another application on Earth, on a bigger sector, where you will be making much more money. So, but in case of Rocket Lab, they did the calculation in the following way. So they looked into, they identified the biggest constellations, and they calculated how many, and from the public announcement, from speaking with them, so they calculated how many launches of small payloads up to 100 kilograms will happen in the next 5 years. So they counted 945 launches, and then given that an average launch is about $5 million, so we can calculate that over 5 years it will generate $4.7 billion, or about $945 million annually. Typically, U.S. investors are passionate about investing in a company if they have $1 billion or more in total addressable market. So Rocket Lab, with their focus on small niche, kind of fits in this parameter. Okay, then a little bit of the context about the market back then. So first of all, launching rocket was still costly. For example, in 2013, there were only 9 launches in the United States, and an average cost was $132 million. And half of those launches were government related. And when it comes to SpaceX, SpaceX conducted only 3 launches back then, and each was carrying 6,000 kilograms of payload, and each launch costed $65 million. The smaller ride-sharing opportunities were done either through Falcon 9 or through Dnepr rockets, and experience significant delays. And we will talk about again in a bit, but Bessemer confirmed these theses of the delays, first with their portfolio company Skybox, and then they talked to one of the major small payload launch brokers, Spaceflight Services, and the company was. As I said that first of all they can play monthly they place about 87 payloads as of September 2014, and yeah, those payloads were delayed like half of the time. Including such big players including constellations like Planet Labs. So this indicated that there is a niche and the niche has a need. Then let's look into the competition. And as I said, there were only two main competitors which were delivering small payloads via ride sharing. It was Falcon 9, which did only 3 launches a year, and the Ukrainian rocket Dnepr. And the other two players, which were emerging players in the niche, were Virgin Galactic with their project Launcher One. But Virgin Galactic was mostly focused on their space tourism business, and this launching business was a side business, and it was dependent on the tourist business, and according to information of Bessemer, back then, the team of this launcher one was only 12 people, and it kind of seemed that the project was underfunded in initial stage. Then there was another player, Firefly. Now it's a famous company. But back then it was a startup which was founded by SpaceX, top SpaceX propulsion lead. And they were working on the rocket which was capable of launching 400-kilogram payload. So they could play in the league with Rocket Lab. But first of all, based on the information of Bessemer, the Firefly was 2 years behind Rocket Lab in terms of technology development. And the other insight was that they were going to increase the capacity of their rocket. So they are in the future they would be more like the competitors to SpaceX rather than to Rocket Lab. And this also gave comfort. So all in all, but Bessemer, of course, was sure that in the future more competitors will be addressing this niche, but at least they had at least 2 or more years of this when they could enjoy the first mover advantage, and probably by then they could build the category leader. So this is how the competition looked like at that moment. So then, as it always the case when you make a decision, an investment decision, we as VC do it all the time. So we talk to experts, we talk to clients, and sometimes we hire outsourced consultants. And for those of you who are going after investments in deep tech and need an advice, please reach out to me, because we are doing such webinars and we're doing what we're doing just to help you better make your decisions better. But getting back to Bessemer, so first of all, they talked to this small payload brokerage provider, and as I previously said, they confirmed the need, and they said that if any company provides a service, they could easily find clients for them, and they will. So on one hand, it's a positive signal, means that there is a need for the product, but on the other hand, it also signals that it will be extremely easy to switch between the providers when a new player will come. So in the future, it means that switching costs probably won't be that high as the competition becomes fierce. But at the moment, it was more like a positive signal so that they could get the clients. Yeah, I'm looking at the comments. Charles asks, since 2030, can you discuss the execution of the business plans, the various stage, why did someone succeed and some failed, was a critical role of some challenges. So today we won't be discussing anything which happened with the company or some other companies after 2013, 15, because today our focus is on how the decision was made. We don't reflect on how the company evolved, but it's a good question, a good topic. Yeah, you can reach out to me. We can brainstorm together, explore it together. So getting back to the industry and customer references. So the first was a good reference from the brokerage. Then there was a good reference from Black Sky and Planet Lab. Especially the last one is particularly important because Planet Lab was going to commit 20 launches with Rocket Lab. So it's a good signal. But they didn't only committed this, but they took it seriously because they first of all made a significant due diligence, technical due diligence, and they even visited their launching site in New Zealand to explore the launching site, the opportunities, and they all in all they gave positive feedback. So you previously you were asking how serious those MOUs. So Planet Labs was very serious. Now let's look into other aspect of the investment memorandum my investment framework. When as a VC, when you make a decision about a deal, you want to answer two questions. First, if the company needs funding, can they close another funding? And the other question is, what will be the exit? So first of all, as I said, like if you look at the space tech landscape back then and the VCs which are going after it, so there were not that many specific VCs which are going after space tech. Now we have much more VCs which are focused on space tech investments. But there were some deep tech VCs, and back then it was like more like wild bets onto one or another deal because there were not there were like just very few deals. So on one hand, it meant that all the VCs, if they need to raise funding, so any VC which they will be talking to, they wouldn't be experts in the field, and they will need to explain like more like general deep tech VCs or generalist VCs. But on the bright side, the niche was kind of just taken up, and the field was experienced to see experience. It was experienced like first startups which were backed, which didn't become like the category leaders yet. So all in all, the investment landscape was kind of positive. When talking about the exit opportunity, the new space era just began, and there were not public companies back then in the space sector, aside from those mastodons like Boeing, Airbus, and other defense companies, Lockheed Martin. But they were not purely space tech companies. They were more like defense companies having space tech angles. But all in all, we haven't witnessed like successful IPOs of space tech company startups. So we just could pray and could believe that if any company builds a solid business with good revenue and EBITDA, they can go public and will be successful on the market, and we could look at multiples of defense companies. And also on the bright side, we also saw those big conglomerates which acquire regularly some defense related and space tech related businesses. So like at least those conglomerates could acquire the company if it doesn't if it's like it wouldn't be probably that successful. Then the other thing, when we make a decision, we need to understand, okay, we get money, we give money to a startup, what they will be doing with those money, and where we get as a result of this round. So this is why we need to look at their business and technical roadmap and to understand like where the company gets in terms of technical and business development after this round. Because typically you deploy, you invest in company and it takes like up to 2 years them to spend all the money, and then they either need to raise another funding or to become profitable. So if we look at the roadmap of the Rocket Lab, so they were planning to launch the test flight in late 2015. So after the first year of the investment, they were planning to do their first test launch. Then they planning by mid 2016, they were going to do their first commercial launch. So it means that the first revenue, the first commercial launch will happen before the end of this round. So this is a good signal. Then they were going, they were planning to do 13 launches, a pretty aggressive plan, for 13 commercial launches by the end of March. So, and Bessemer believed it was aggressive, but anyway, they also hired a technical due diligence consultant which had to validate this plan. Yeah, so give me a second. I see a question. Yeah, give me a second. At the moment of the deal, how did you do technical due diligence in general? Who do you ask to independently verify the technology in such deep tech startups? So it all depends. So when you do a business angel investment, for example, or your seed round, so you don't have a lot of money to do a technical due diligence. But in Series A's and Series B's and beyond, you hire outsourced consultants, and Bessemer did exactly like that. Even given that the partner which was doing this deal has 20 years in deep tech investments, and he was on the board of a company, a space tech company. So even given that he was kind of an expert, he hired an outsourced consultant who did a technology due diligence on their behalf, because like this is like $20 million rounds, like they have some money to allocate for such consultants. But where they hire them, they use their network, they look for people who could potentially be useful, look who could potentially do this due diligence. And by the way, if you need something like that, please don't hesitate to reach out to me. Yeah. So another aspect which is really important, especially important for the deep tech companies, is the team. And as of the date of the deal, the team of Rocket Lab was 25 employees, and the majority of them, and 25% of them were has PhD degrees. They were very deep in technologies. And let's look into several like main personas. So first of all, Peter Beck. Peter Beck was he's a pretty interesting guy, and he had energy, spirit, vision, and and Bessemer boldly says about it in their memo. So he kind of he's a like this hustler type of the businessman, which impresses VCs. And he also got a lot of various awards in New Zealand, and he worked in a composite company, in superconductor company, and so he had engineering background. And he also, as a student, when he was as a student, he built a jetpack. So he was kind of first of all, he had engineering background, and he was really passionate about what he was doing. And before raising money, he kind of had many achievements before that. Then, of course, he had a business angel, which US business angel, which also supported him early in the journey, not only with the money but also with the network, some understanding of how the business is done in the United States. It was also a good signal. The other main roles were taken by people with solid space tech experience. You can read about them, and some of them, Solomon. Westerman even worked for NASA, and he was also at SpaceX. So kind of a respectable team, both from business and technology perspective. Now, the other part of the framework is, of course, financials and client pipeline. So we don't have a solid business a financial model here, but so what we see is that they have 40 launches, 200 millions of dollars in the pipeline. 20 launches are coming from the Planet Labs, which are planning to launch about 100 or more satellites. There are several other small pay launches. They have a Spirit Fly services, the brokerage company, which is going to place first 6 launches in the first year. And yeah, so that's it about the business traction, the financial traction, and the pipeline. Let's talk about the technological traction. So Rocket Lab, before that, they raised a $5.5 million Series A from Khosla Ventures. And the Series A round was essentially about taking all the technological risks. So if you look at the money which were remaining and the stages which were done, if you look at the picture, so the majority of technological risks were taken as a part of this round. While yes, some technologies has been not been tested in space, but more or less the technology was ready to launch their to start constructing their first rocket in 3 to 4 months, and plan to launch like within a year of the first test flight. So the commercialization was around the corner, and the majority of the technologies were developed. So that gave a lot of comfort to investors, to Bessemer. The next parameter, which is really important, is barriers to entry. And so every time you talk to VCs or accelerators, you hear they ask you like, what's your secret sauce? What's the barrier to entry? Why it's not easy to replicate what you're doing? And the reason why we ask this question is because if the barriers to entry are low, it means that customers can easy to switch between providers, and the margins of your business goes up. So this is why if you're building a business or if you're making a decision, yeah, try to answer like why is not your this business couldn't be easily built and killed by the competitors. So when it comes to Rocket Lab, of course, there was a significant technological barrier, and it will take competitors a few years to develop the technology. And as I previously stressed, they had 2 years of at least 2 years ahead of the closest competitor, so they could enjoy it. But on the business side, so as I said, like the clients could potentially easily switch between the solutions, and in the long run, it will it will make significant pressure on the costs, on the pricing of the company. Could do that. And but on the bright side, as you remember, I said that the launch was planned to have they planned to charge $5 million per the launch, while the cost of the launch was about $1 million. So they had significant room for cost reduction. For price reduction, and probably also the technologies will be developing, the scale, the economy of scale will be working. So they could work on this cost optimization in the future. Yeah, let me look into the questions. At the moment of the deal, how did technology in general words, who you ask independently, verify technology such deep steps? I already answered to this question. How meaningful is the financial model at such stage? Would it mostly rely on backlog, market size, and assumption? So in general, of course, for deep tech startups, financial model at the earlier stages is essentially the assumptions about the costs. So so what you need to do is need to do the calculations of how much you will pay for monthly salaries, components, experiments, testing, etc. Because the revenue is coming like in years, especially if you're looking at the pre-seed stage, at seed stage startups, when revenue is like 3 to 4 years before, like ahead in the future. The financial model is pretty simple, and it typically shows like how what is the burn, and where will it take us? Will it take us with the company? Uh, in the Series B round, we could build a more sophisticated financial model, but it will be also pretty simple, showing okay, we will have like 10 launches, each cost this much. We will charge. We will need to buy components and spend something on that. So it's more like accurate calculation of the cash flow, but it wouldn't be pretty sophisticated at this stage, given that they are not making revenue at the moment. Okay. Did you do any analysis of the IP portfolio of the company at that time? So, look, it was not my deal. So I use about the public information about the deal which was done by Bessemer. I don't speak on behalf of Bessemer. I'm just showing you how they made this decision. I'm pretty sure that the IP was and the know-how was part of the technical due diligence, but I believe that most of that was done by third-party experts, not the team of the. So the next question: how do you how you calculate the valuation if the company is pre-revenue? I'll tell you what. This is this is valuation is always is the price at which both parties want to make a deal. So in general, you take about 20% of the company. So you can't try in case of Rocket Lab, you were not doing this sophisticated financial analysis for making this valuation. It just was like, okay, if I believe this company could cost like could be valued at 500 millions or $1 billion like 5 years from now, like how significantly will grow my share. So it's that type of the valuation exercise. But if you want to go deeper into how this valuation are done for in deep tech and practice, you ping me and I tell you, because it's more like an art, I would say, than a strict formula. Yeah, I have a second master's degree in corporate finances, and I did valuations for more sophisticated and more advanced assets and companies. So in venture capital, those valuations, they are very, you know, very simple. And, you know, you can't sometimes prove like how you did this valuation. So the other thing which we typically consider is uh, uh, how like no one thing I want you to stress here is who did the deal. So I looked specific. It's not the part of the analysis typically, but I wanted to show you the partners who did the deal in Khosla Ventures and did the deal in Bessemer Venture Partner. So for you to understand the background of the people. So first of all, in 2013, so a year and a half ago, the company raised $5.5 million from Khosla Ventures, and it was done by Sven Strodband, and this partner, he joined the team just a year before this deal was closed. So he was pretty new in Khosla Ventures, but before joining Khosla Ventures, he worked as a CTO for another venture fund, smaller venture fund, for 6 years. So he was pretty experienced in doing deals, and he was a CTO. He was specifically doing analysis, technical analysis of the deals. And he also has a PhD from Stanford, mechanics and computation. So he was like pretty well equipped for doing deep technology deals. Then, if we look at the two people which did the deal on behalf of Bessemer Venture Partners in 2014, there was a principal, Sunil, who did the deal, and he joined like in 2011. He had an MBA from Harvard, and he had a bachelor degree in computer science. So he was kind of, but it was the first deal for him in SpaceTech. And if we look at the partner who was managing this deal, David Cowan, so he was a partner at Bessemer, DeepTech partner since 1992, and so he has done pretty many deals in the in DeepTech in general, and he made an investment in Skybox, and since 2010 he was on the board of directors of Skybox. It was another SpaceTech company. It was a satellite company. Yeah, and because of these achievements, it was easier for him to make this SpaceTech investment decision. Yeah, and the last aspect we always need to consider are the risks. So the first risk, of course, yeah, let me look into your questions. Okay. How do you assess the future financing risk, especially if technical milestones would be delayed? I mean, how much extra runway you expect a space tech startup to have before the funding needs becomes too high? So, where if the company is delayed, like for example, they are 6 months behind the schedule, then it means that typically you do a bridge round. So you calculate, okay, you will need $2 or $3 million of extra funding to reach the milestone. Then it means that those bridge rounds are typically done internally by investors, and we as investors we typically consider that we will do it if it comes to the problem. What we need to answer is actually can the company will breach like the milestone, some technological and financial milestone by the next round. And in case of Rocket Lab, there were significant, yeah, it was potentially it could happen that over the next couple of years they couldn't launch any company, any rocket, or for example they experience some technical disaster. It's an unforeseeable risk. It could kill company, for example, or it could cause like to do a down round on some extra round. But the base case scenario was that the commercialization was around the corner, and this what was making this next like underfunding risk like moderate. But it's not that like you don't calculate this risk. You just assess it like it's gut feel combination of gut feeling and your background and some like quality parameters. Okay, and okay, taking unfortunately I don't speak French and I can't answer your question. Sorry. Okay, so now talking about the risks. Again, there are like several types of risks you should consider when it comes to this deal. So first of all, of course, there was a technological risk, but first, as I said, like the majority of the technology was developed before the round. The main risk was that we do a flight in space, test flight and commercial flight, and there was some technologies were not tested in space, and it could like incur an additional risk. But to validate this risk, to become more comfortable with the risk, they hired a technical due diligence consultant. But all in all, risk seems to be moderate. So the other risk was risk under investment, but again, we consider it. So first of all, like the coming round and don't to fund it is like get a lot of like a lot of money to develop the technology, and then again, the company has previously raised only 5.5 million, so they had room for extra investment if they need it. Then the business risk, of course, it's as it's always the case with deep tech, since the company is still pre-revenue, it could be could happen that it will be delayed or whatever can happen. But there were significant positive signals about the commitments, about the interest from the client, about the interest from the brokers, and the most important is that the commercialization should happen within the next one point like one a year and a half. So it gave the comfort, more comfort for investors, and made this risk bearable. Then the competition risk, as I said, like in general, in the future, the competition will become more fierce. But since they were at least 2 years ahead of all the other players in the field, so they will have a few years of relatively low competition. So it also made this risk acceptable. Then another additional risk is risk of switching between the clients. This is essentially the risk of the future competition. But again, as I said, out of $5 million, the costs of the launch was only 1 million. So of course there were some other costs, but they had room for optimization, price optimization. So when the competition becomes more fierce, they can kind of decrease the price and compete. So and now let's do the summary. Again, there are about 13 points which I believe why this deal was good for Bessemer. So first of all, the niche itself of 100 kilogram, 150 kilogram small payload launches was underserved. It was a billion-dollar niche, and there was a strong need. Clients of it was a painkiller, not a vitamin. Then, as of October 2014, the company was very close to starting test and commercial flights. So many technological risks were solved. Then they had like pretty solid pipeline and $200 million in potential revenue. Then they had partners. They targeted a niche where there were no competitors, and they were the first player doing this. Then they had a really good founder and a really good founding team. They also had strategic investors on board, and they have some investors which were following on after Series A. Then Rocket Lab had also and some non-dilutive funding, which gave extra runway for the company. Then the company had higher profit margins and room for price optimization in the future. And all in all, the VC market was in the deep tech in space tech was kind of nascent, and the big financial crisis was just recently over, and the market was recovering, and so there was like a pretty good time for raising. Then there was also positive signal from collaboration of the company with DARPA and Lockheed Martin, and this also the business model. They didn't only use technical innovation, but also business innovation in standardizing of assembling rockets and the ways they dealt with the payload. And the last but not the least, the deal was done by an experienced but an experienced DeepTech found VC and who had previously experience been investing in the been on board of directors with a space tech company. Okay, this is it which I wanted to say. Yeah, let me look into your comments. In your experience as a VC, what creates strong support for deep tech infrastructure company? The technology is proprietary data, institutional partnerships, or distribution. So, in deep tech, oftentimes you sell to very sophisticated clients. So, the fact itself that you can sell to them could be a moat alone. But the technology could also be could in oftentimes is also the moat. But all in all, there are like over a dozen of various modes which you could have, and oftentimes it's just a combination of one and another. And especially when you go to some regulated spaces, so the regulation could be a mode, for example. Okay, yeah, I need to leave. Okay, thank you. Out of 10, how deal was out of 10, how ideal was this opportunity for Bessemer given all these advantages you just mentioned? I believe it was like 7 or 8 out of 10 because yeah, maybe it was a pretty good deal. Of course, they didn't have a lot of experience in space tech, but they had experience with deep tech, so they kind of understood what was happening in the field. They had a pretty strong team, good niche, good traction. So I believe 7 to 8 out of 10 for sure. It was yeah. 9 out of 10 it would be for them if they would invest, for example, in some more lightweight businesses, but it was a pretty good deal, I believe. How do you assess the exit path potential, especially in case, given that the fact that there were not many proven VC-backed space tech exits at the time? It's not only about you face this problem all the time if you deal with new niche. For example, I did for one US VC, generalist VC, I did an exercise. They wanted to invest in quantum computing. So back then, when we looked into, we mapped about 200 companies for them. Back then, there were no deals, no public companies at all in the quantum computing space. So when you don't have successful cases of IPOs or M&As in the field, then you suggest, first of all, if you build a solid business with solid EBITDA and margins, then probably you can place it. Then you can do analogies. For example, for the quantum computing, you could do for quantum hardware, you could compare it with other companies which do compute, like NVIDIA or something like that. In case of space tech companies, satellite launch companies, you could use some proxies looking at big companies which are in defense space, like Boeing, Airbus, Lockheed Martin, and a dozen of other companies. And you could look at their multiples, look at some information about their space departments. And of course, when it comes to M&As, you could look into the M&As which happened in this defense space, because those companies were acquiring and they had acquisitions of hundreds of millions of dollars. But yes, when you deal with a new niche, you kind of believe that if you build a solid business, then M&A and IPO will happen. While if you operate in the niche, well, where there were previous successful exits, you could look at them as examples. Okay. Do you have any other questions to me? Okay, I see another question. What do you think of space-based software companies that are emerging in the last 4 or 5 years? Usually those startups have no defensible moat and very narrow way of making money. Uh, uh, I believe that they have some moats because at least you're launching something into space, so you need to go through some certifications and test flights, etc. So you have the mode. But the problem, the second problem is more important, because currently, if you, especially when you look at some software for satellites, it's a very narrow niche, and that's the problem. This is why I mentioned that previously mentioned that to calculate total addressable market for space-time companies is really crucial, because and oftentimes I advise many founders, let's look where else we can use your technology, not only in space but probably for defense, or for construction, or for discrete manufacturing, or something like that. The later limitation that they have a very narrow market. Even if you forecast the growth of this market over the next decade, it still be very narrow, like for example $100 million or even less. That's the biggest problem, the biggest challenge which I see. But I've seen some companies in the software play which saw like, okay, we can implement this elsewhere, and then we land on a bigger, more lucrative market, and yeah, we can build such companies. Okay, any other questions so far? To be honest, I'm giving this webinar from Europe, from Spain in particular. But yeah, I work for New York VC myself for the last 12 years. It's just for family reason I live here. Yeah, but if any of you would like to meet in person, yeah, I believe we can find some ways. Any other questions? I'm based in Barcelona. Um, I love the sea. What would be the most credible milestones for quickly gaining trust from conservative institutional players such as banks, insurance, or trade finance sectors? Oh, these are not the easiest. Um, yeah, let's talk about it like afterwards. Uh, but insurers are very tough players. I'll tell you, because I have a friend who is specifically going after investments in the insurance tech, and yeah, it's a very tough it's a very tough sector. Okay, any other questions? Yeah, what would be the best way for a startup founder beginning to fundraising to reach out to you? I didn't understand the question. So you can reach out to me. I'm not sure if I can invest in you at this stage, but at least I will guide you what would be the next step. By the way, if you're planning to raise funding, and we will be doing in a couple of weeks, we will be doing our regular pitch deck polishing sprint. So you can join, and we will be polishing the deck, and you will learn more. Um, yeah, sure. I will send. So you will. So first of all, here is my email. I will also be sharing this video recording and my contacts after the webinar tomorrow. But yeah, sure, sure. Yeah, and another question from your perspective: what mistakes did Rocket Lab make along their journey that impacted on securing long-term funding? I can't answer this question because I didn't prepare. I wasn't prepared for to answer it today. Let's do another call where we look into their history and some facts and understand. But all in all, I believe they're a good company. So far as I know, they expanded their business to the satellite business as well. So they've also are building vertical integrated company, similar to what SpaceX does. Not the similar, of course, but also they have a pretty big satellite business now. Yeah, thanks everyone for joining. I really enjoyed our conversation. I hope I didn't tire you. And please don't hesitate to reach out to me in the future. And yeah, I wish you all succeed and thanks for your interest to space tech. Yeah, and remember, sky is not the limit; it's just the beginning. Bye bye.